Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management, and every day on Facebook we give you these posts talking about the economy, talking about investing, making you a smarter investor. Well, today, I've been hearing a lot of talk about tying executives and CEOs' pays to the price of a stock. And people think, wow, that'd be a great idea because the stock should go up. If it goes up, they should get paid more. If it doesn't, they shouldn't get paid more. Well, it's not such a great idea when you dig into it, is it?
Yeah, I mean, it's really not good for long-term growth because it puts a lot of pressure on the CEO to prop up the stock price. Mm-hmm. A lot of times we've seen the market, there's a lot of great companies that are undervalued and their stock price doesn't reflect the great job they're doing. Well, that hurts the CEO pay, and he's, wait a minute, there's some things I can be doing to improve that pay. One thing they could do is they could borrow and take on a lot of debt and buy back stock, which would increase the short-term productivity of the stock price, but not the long-term growth of the company.
Yeah, and the debt could be enormous, and they wouldn't care because the stock's going up because they're buying back all the stock, and they don't care what happens long-term to the company. It can falter. So again, raising debt is not a great idea for them to do. They also might do things like cut R&D expenses, which is research and development. Like, who cares about the long term? We'll cut R&D because that will increase our profits. Increase our profits, we'll have more cash to buy back more stock, and they'll focus just on that. So not a good idea to focus on the stock price or tie the stock price to CEOs' bonuses or pays. Don't like that at all. Look at long term for a company.
Yes.
Today we had the new home index come out, and it was the same as last month, 58. And again, anything over 50 is a strong number. Some good numbers on this report coming out today.
Yeah, anything over 50, that means they saw an expansion in the productivity of the housing index. Anything below 50 is a contraction. So 58, very strong number here. One thing that they pointed out is kind of a negative is, they're still having a hard time, and there's a shortage for labor. The electricians, the carpenters, all those people needed to make houses, they're having a hard time finding those people. Also, they said there was a shortage in lots and land to build those houses on now.
And that could be a problem because down the road, we could see prices rise artificially because of the fact that these shortages. But on the bright side, buyer traffic, a lot of people coming through looking now. Before, a few months ago, wasn't that good. It's starting to increase. Maybe the weather has something to do with it. But sales remain strong, which is looking pretty good as well.
Yeah, that's nice. And the high buyer traffic, that means more people are coming to see those houses, so we could see sales continue to be very strong going forward. And spring season, there's a lot more people out there looking for homes.
And again, the investment tip here, look at home builders. I think home builders are going to benefit from this down the road.
Yes.
So, alrighty. Also today we had a company called Valeant, which was down about 50% today. You can see how high this stock went. It was up to almost 200, I think it had like $260 a share. Today, around $33 a share, this is being plummeted, this stock.
Yeah, I mean, look how short of a time frame that is. That is 2015 right here, 2016, and it's plummeted within, less than a year.
Oh, yeah, I mean, because it started, here was a big rise, like, oh, how great it was, and all of a sudden, bam, it just fell off, and this is probably, what, 3 months, 4 months, 5 months?
Yeah, and I mean, going back to yesterday, talking about growth versus value, this was a great growth company. The stock price was going up very quickly.
Right.
And then, it's not a great value company at any of these points. I can almost guarantee it. And all of a sudden, it falls out very quickly.
Now, let's talk about the danger of this company here. Now, actually, Bill Ackman, who is a big hedge fund manager, I always tell people, be careful of hedge funds. They take on a risk. He's been talking so positive about the stock, even as late as March 1st, saying, all is good, don't worry about it. Well, today the stock fell 50%. I don't know what he's seeing.
I'm not really seeing it either. And, taking a look at the company going forward, like we always like to do, 2017 estimated earnings per share, estimated $15.46. That sounds pretty good, right?
Right.
Well, here's the GAAP number, $7.46, about half of what the pre-exempt is. So they're backing out a lot of stuff. Not too sure what they're backing out here, but definitely scares me a lot.
Yeah, and they've got a lot of debt there as well, which we don't like. We talk about how bad debt is, and actually the hedge fund manager Bill Ackman, he owns almost 17 million shares of the stock. He's been on this stock for over a year, doing some quick math. Not sure when he bought it, but at $200 a share, his investment is worth about $3.4 billion. Today, those 17 million shares worth about $600 million. So he's taking a big hit. This is not his first miss. He also missed on Herbalife trying to short that company. I don't know how this guy manages billions. He keeps it up. He's not going to be managing billions, is he?
Yeah.
And we do talk about the debt a lot. And if you want more details on this is our newsletter for today. We do a newsletter every Tuesday. Really dug very deep in this company because I want to show people what to look at. And a lot of people say, oh, hedge funds are good and so forth. I do not like hedge funds. They charge high fees. and also they take big risks and they leverage themselves. So if you got a leveraged company and they're leveraging, that's even more leverage there. So maybe you think that investing is hard. Well, I'll tell you, it is hard. That's why we do this for you. That's why we do the consultations. You want to come for a conversation, give us a call at 858-546-4306, or go to our website, smartinvesting2000.com. A lot of great information there, but also you can contact us by email as well.
Yeah, and be sure to go to our website now so you can sign up for our upcoming workshop this Saturday, March 19th, from 10 a.m. to 12 p.m. We'll be hosting it at National University in Rancho Bernardo, and at the workshop, we'll be analyzing locally based Qualcomm. Think it's a buy? I don't know. It's a potential buy in our portfolio, I'll tell you. We'll tell you at the workshop, actually. We'll also be reviewing stock fundamental analysis and why it's successful. We'll be telling you when to buy and sell a stock and going over the 5 common mistakes the average investor makes.
Hope to see you there.